And welcome to this Sustainalytics webinar on our new thematic research report entitled 10 for 2018. My name is Loïc Dujardin and I'm a member of Sustainalytics research product team based in Tokyo, and I have the pleasure of being your moderator for today's webinar. Before we begin, I would like to highlight some housekeeping details for you. You are currently all muted and you will remain so for the duration of the webinar in order to minimize any noise disturbance. We invite you to send any questions you have about the presentation to me through the interactive box you see on the right-hand side of the screen and highlighted with the number 1 on this slide. I will ask your questions to the presenters during the Q&A session. If you have any audio problem during this webinar, you can also inform us through the interactive box. Also, if you would like to minimize this interactive panel, you can simply do so by clicking on the arrow at the top of the panel indicated by the number 2 on this slide. And finally, this webinar is being recorded, and a copy of this recording will be sent to all participants in the coming days. So we are delighted that so many of you can join us today, and I would like to extend a special note of welcome to those of you who are joining us for the first time. For those of you who are not familiar with who we are and what we do, we are a responsible investment research firm providing detailed ratings and analysis on companies' environmental, social, and governance risks, otherwise known as ESG risks, used by both global asset managers and pension funds in their investment decision-making process. We have over 350 staff located in 13 offices in Europe, in North America, and in Asia Pacific, and we rate approximately 7,000 companies globally, reflecting the major market indices, and this rating is used by more than 450 clients. We also produce thematic research report on a wide range of ESG topics, and today we are delighted to present you the findings of Sustainalytics 10 for 2018 report, which is part of our annual thematic research series exploring the ESG-related investment themes we expect to develop over the coming year. In our 10 for 2018, we focus on the ESG issues we anticipate could pose significant risks for investors across the globe. The issues in focus fall into 4 broad themes: water management, climate change, consumer protection, and stakeholder governance. And today we will focus more specifically on the following industries: oil and gas, mining, semiconductor, real estate, apparel, and food. I'm joined today by Martin Vazer from our thematic research team, and Ais Bhaskaran and Justin Cheng, 2 industry analysts who co-authored this report. My colleagues will present the stories of this report, and the presentation will take approximately 35 minutes and will be followed by a 20-minute Q&A session. So without further ado, I will now pass over to Martin, who will begin the webinar presentation. Martin, the floor is yours.
Thank you, Loïc. Hi, everybody, and welcome. We're very delighted to present our research on these interesting and exciting themes for 10 for 2018. Today's agenda will start with a background to look at how we arrived at our approach for this year's contribution to our 10-4 series. We'll then look at the approach that we took in this year's edition of this report. We'll take a quick overview of the 10 stories with a particular focus on 6 that we want to get a little bit deeper into for today's session. We'll then have a quick update on last year's edition of our 10-4 series, 10 for 2017, followed by a wrap-up to review some of the key findings of this year's report, and then we will have our Q&A session in which we hope to interact with you and address any questions and comments that you may have. Okay, starting with the background. This is the 4th iteration of Sustainalytics 10-4 series. This year, the themes that we focus on all center on issues related to risk. If you're familiar with our other 10-4 reports, you'll know that we call the reports 10-4 because we look at 10 interesting themes that investors can be looking out for in the new year. This year, all of the themes are going to be concentrating on risks that are on the horizon. As with our other reports, we customize our ESG analysis to address the themes in question, and we profile one company for each of the themes that we look at for a total of 10 companies. This year's report also has specific focus on industry risks, so you're going to get a sense of 10 key industry risks that are on the horizon, 10 key companies that you can look at to get some deep analysis on how they are addressing the risks or how they're not addressing the risks in some cases. This report also has the advantage of drawing on the expertise of 14 analysts from across Sustainalytics. I think this is a really key part in getting to the depth and breadth of the issues that we cover. We have expertise coming from 10 different sectors, and I have two of my colleagues who are sector experts who are going to be getting into two of the papers that they co-authored in this report, and we'll be happy to cover a range of other industries that we cover in this report as well. The approach that we took this year is similar to the one that we took last year in 10 for 2017, which is to have a really succinct analysis for each of the stories that we cover. So the 10 stories each will comprise 3 pages. In the first 2 pages of each story, we take a top-down view of the key themes. In this case, the key risks, the drivers of the risks, and the financial effects. We provide an ESG analysis, we do an industry assessment, and then we focus in the 3rd page of each story on a particular company. In this case, we will focus on companies that are either performing particularly well in mitigating the risks in question or poorly. Now, this is another point to note in comparing this report with last year's report. Last year, we had 10 upside stories for each of the profiled companies. This year, we have a little more variation. We have 6 upside stories, but 4 stories that are particularly aiming at highlighting some of the poor performers in the market, which we think provide interesting lessons for investors and corporates alike. As Lulik mentioned, the 10 themes that we cover in this report can be categorized in 4 large categories. For the sake of time, today we'll only cover 6 of the stories featured in the report, but for the sake of completeness, I'd like to mention the 10 industries that comprise the full scope of this report. Under the heading water management, we look at copper mining and diversified chemicals. Looking at risks related to climate change, we focus on semiconductor manufacturing, oil and gas, and real estate. Risks related to consumer protection focus on software and services companies, companies with exposure to beverages, and financial services. Stakeholder governance risks are found in industries including apparel and aerospace and defense. And as you can see in this map, we have coverage of operational risks that span much of the globe. We discuss water risks and community risks facing copper miners in Chile and Peru. We look at hazardous releases from chemical producers in the US and Europe, low carbon transition risks facing oil and gas projects in Canada and the high Arctic, energy issues in semiconductor manufacturing in Taiwan and China, climate risks to real estate in Australia, antitrust scrutiny of tech firms in Europe, Israel, South Korea, India, and Japan, health concerns about sugary drinks in the US, Mexico, and the United Arab Emirates, data security regulation of financial services in the European Union, supply chain risks facing apparel production in Bangladesh, Myanmar, and Ethiopia, and an aerospace and defense bribery scheme linking activities in Brazil, the Dominican Republic, Saudi Arabia, Mozambique, and India. The first story that we're going to discuss today is called Mind the Gap. This story focuses on copper mining. We're looking particularly at risks facing copper mining with respect to water supply issues and community relations. We note at the outset of this story that copper is an attractive commodity today. Its demand is on the increase. The price surged in 2017, up about 70% since early 2016. We expect this demand for copper to continue to grow. We mentioned one area of interest is electric vehicles, but of course there are others, other sources of demand for copper in the market. With this demand, risk is also on the horizon. We concentrate on Chile, as this country is particularly well placed in the market for producing copper. As you can see in the figure on the left side of your screen, Chile accounts for a large proportion of copper reserves and production globally. In 2016, it accounted for 27% of global output. Chile is also particularly interesting when looking at water and community risks because this country is facing significant water stress. Farmers and communities are affected by drought in this region, and they've focused their attention on copper miners who are drawing on water supplies and in some cases contaminating water supplies. We note that protests in Chile and Peru can delay production. They can lead even in some cases to decisions to abandon certain projects. So this risk is very real and something that investors in the industry are of course aware of, but we think that this kind of issue could reach a tipping point, and 2018 is a good time to really take a close look at what is going on in the market. As you can see in the figure to your right, we assessed 6 mining majors, and we focus on really 2 factors, as you can see in this figure. One is what we call water-driven community risks. That's depicted as a line in this figure. And we also look at the production of copper within Chile. Now, we focus on Antofagasta in the profile. We consider Antofagasta as a strong leader in community and water risk management for several reasons. We note, of course, that the company has faced related controversies in the past, but the work it has put into managing its ESG policies and implementing programs is beginning to pay off. The company has reached agreements with several communities in key areas where it has mining projects. And particularly notable, the company is now already using seawater for much of its operations. 48% of its water use for mining came from the sea in 2016, which positions the firm well in reaching the expected 50% seawater use for Chilean mining firms as an industry by 2026. The next story that we're going to look at today, Survival of the Greenest, is focused on the low carbon transition and the risks that this transition can pose to oil and gas companies. This type of transition can affect the profitability of companies in the oil and gas industry. We note, as you can see on the left side of the screen, renewables have been surging while oil, gas, and other fossil fuels and even nuclear have been growing at a much slower rate. Since 1990, renewables are up 1,200%, which compares to 78% for gas and 37% for oil. The drivers of risk in this space of oil and gas include government regulations, which could translate into carbon pricing. We note the importance of the Paris Agreement and countries taking initiatives to meet their targets. Also consumer demand could affect the profitability of oil and gas companies, as many consumers are now shifting towards renewable sources of energy, electric vehicles, and other markets that can displace some of the demand for oil and gas. We assess companies on their GHG risk management capacity. We focus on whether they have strong initiatives to measure and disclose and manage regulatory, market, and reputational climate risks. As you can see on the chart to your right, we take a close look at 10 of the largest public oil majors. We profile Shell as a leader in the industry. This is the only top performer in our assessment which has a carbon reduction target. This makes Shell stand out. We also note in the profile for this company that we see an upside in its risk management capacity. The company is exposed to the electric vehicle market. It has also sold assets in the Arctic and in the oil sands, which we think really illustrate that the company is preparing to diversify its portfolio. Our next story, which is also focused on climate change, the need for renewables, will be covered by ICE.
Thanks, Martin. So this story, the need for renewables in Asia, is a story about energy risks in the semiconductor industry. As you might know, in this day and age, semiconductor chips are everywhere, whether it's your smartphone or your connected car or your smartwatch. Asia plays a key role in this $409 billion semiconductor industry. As represented in this super colorful donut graph on your left, about 70% of worldwide semiconductor manufacturing takes place in Asia. If you take a closer look, Taiwan and South Korea are particularly key players with 21% capacity for both of them. They supply chips to the technology industry. Semiconductor manufacturing, which is considered high-tech, usually takes place inside clean rooms, where temperature, humidity, and even the content in the air is monitored and controlled constantly. Because of this, a continuous supply of energy is crucial for semiconductor manufacturing. Any type of interruptions or low-quality electricity could lead to equipment failure, and in some cases, even operational shutdowns. Certain regions in Asia, particularly Taiwan, is grappling with energy shortages. There are a variety of reasons for this. However, a major reason is the increasing demand for energy and an ongoing transition away from traditional energy sources such as coal and nuclear. To make things a bit more complicated, several countries in Asia are beginning to adopt carbon emissions regulation. And a recent example, as you might have seen in the news, is the launch of a carbon trading scheme by China in December 2017. Given these risk factors, for this story, we took a closer look at about 42 global semiconductor companies and their performance on greenhouse gas management and renewable energy programs. We found that about 50% of companies are poorly prepared to manage related risks, and preparedness further goes down when you take a closer look at Asian firms, with only 23% of firms well prepared, while about 31% of North American peers and 43% of European companies are well prepared. We profiled the largest dedicated semiconductor manufacturing company, Taiwan Semiconductor Manufacturing Company, or TSMC for short. TSMC is unique in the sense that it does not design semiconductor chips. It exclusively manufactures them. Companies like Apple and Qualcomm, they design these chips, and then they ask TSMC to manufacture these chips. So Apple and Qualcomm and a couple of other companies are customers to TSMC. The company, despite being in Taiwan, where a power outage last year affected about 151 companies and cost $3 million in damages, the company stands out. In the figure on the right, you can see the percentage of fab capacity TSMC owns in the 200 millimeter range as the bar, which is about at 11% worldwide. And you can also take a look at the performance score as the line graph. The company invests heavily in standby energy systems. So even though the company was affected by the power outage last year for 5 hours, it came out of it without any damages. And the company also has established a greenhouse gas management committee and uses an internal carbon price to make strategic investments. Although Taiwan as a country has very little renewable energy to purchase, the company is the country's largest renewable energy purchaser and has made commitments to increase procurement moving forward. So with advances in communications such as 5G and connected devices within the Internet of Things revolution, we expect the demand for semiconductor chips to increase in 2018 and beyond. Simultaneously, we expect TSMC and other semiconductor companies to invest in renewable energy options to tackle energy and greenhouse gas regulation risks. Now my colleague Justin will talk about climate change in the real estate industry.
Thank you, Ice. So I'll be presenting the changing climate in real estate story. So in the past, the real estate industry's ESG focus has long been on greenhouse gases, resource efficiency, and waste management. And there are a number of reasons for this, but some of the main ones include results that are more visible, for example, a cost savings to a company's bottom line, measurable in the sense of well-developed metric measures of performance, and most importantly, is widely understood by investors and the public. And while these are still undeniably very important, climate change impacts in the past few years have raised questions among investors on how real estate companies are addressing the issue to mitigate risk of financial losses. And I'd like to bring your attention to the chart in the middle of the screen, specifically global real estate market, and to the figure of 51%. And this is derived from our ESG research, which shows that physical climate risk issues are still not widely considered within the global real estate market. And for companies who are considered moderately prepared, they may engage in activities such as reporting, to executives on climate change impacts on an annual basis, and incorporating resource-efficient design and practices to minimize climate change impacts within their operations. For companies that are considered well prepared, some of these initiatives may also include commitments to long-term climate targets, such as adherence to the COP21 Paris targets and the United Nations 2030 Sustainable Development Goals, and embedding climate change action as part of their company policy or code of conduct. But despite increased attention globally and the signing of new climate agreements, the Earth's temperature is anticipated to surpass the 2-degree increase threshold by 2030, according to a 2017 UN Environment Synthesis Report. And in particular, the Asia-Pacific region is considered the most disaster-prone area in the world, as climate science projects reshaped weather patterns leading to more severe hurricanes, floods, and droughts. And incidences of once-in-100-year events are also becoming more frequent, leading to billions of dollars in damages and losses for the industry. And as a part of this story, we put a spotlight on Stockland Corporation, whom we consider as a leader in physical climate risk and ESG management. And as you may see on the chart to your right of the slide, when compared to when Stockland is compared to a selection of Australian industry peers, it does rather well. Most notably, their move back in 2011 to utilize external research to identify climate change vulnerabilities and risk within its portfolio was quite forward-looking at the time for real estate companies, as it was generally not on the radar for many of its peers and much less an action point. So the company recognizes and commits to managing climate and environmental impacts of its operations through their Climate Change Action Plan, which is a mandate that focuses on monitoring and reducing emissions, adapting to potential future risks, working with suppliers on innovative solutions for projects, and strong communication of its position and performance. This can be seen in their Climate Adaptation and Resilience Assessment Framework, which is used to identify future long-term risk, as well as operational and emergency readiness at the site level to address identified risk within their portfolio. This is also reviewed on an annual basis, which is key to staying ahead of a dynamic global issue. I will now pass it back to Martin, where he will discuss our next story.
Thank you, Justin, and thank you, Ice. Our next story focuses on the apparel industry, particularly the shift in apparel suppliers from areas in Asia to places in Africa. We note that supply chain risks related to working conditions are well known in the industry. The case of the Rana Plaza collapse in 2013 is one example, highlighting how problems in working conditions can lead to, as well as local difficulties for communities, the unrest and disturbance to suppliers and brands can lead to other issues, including legal actions against companies associated with such supply chain problems. So we take a look at how the industry has taken a look at other areas where they can enjoy some of the benefits of working in countries that have access to markets. We highlight Ethiopia as one example of an area suppliers find attractive for several reasons. It is in proximity to markets in Europe. It is also eligible for duty-free sales to the EU and the US. Moving to these markets, though, also comes with risks, risks that are prevalent in areas in Asia can also emerge in areas where suppliers are developing projects in Africa. So we developed an assessment of the industry to look at supply chain standards and management practices of companies in the apparel industry. As you can see on the figure to your left, Ethiopia is particularly interesting example when you look at some key indicators such as the exports of textiles, clothing, and footwear, which have been on a steady growth spurt since 2006. We also note trends in direct foreign investment and other issues that really speak to this point of Ethiopia becoming an important area for suppliers to develop operations. The figure on your right shows a cross-section of the performance of 10 companies on our apparel supply chain standards and management assessment. We do an analysis on the full industry as we do with our other stories. And the full industry analysis shows that only 20% of the companies in this space are well prepared to address supply chain risks. At the top of this selection, you can see H&M stands out as a leader. We profile H&M as particularly well placed to mitigate supply chain risks. Since 2015, the company has been mapping its supply chain, which increases the transparency and traceability of its global suppliers. This company is also involved in getting supplies from operations in Ethiopia, and the company has engaged with the Ethiopian government on workers' wages and is currently paying workers in the country 69% more than the minimum salary. Of course, this company also has a record of being involved in related controversies. We highlight these problems. We note that we think H&M has learned a great deal from its track record, and we expect the company will be improving its supply chain management moving forward. Okay. This is the final story we're going to detail today, and it's one that is different than the others we've gotten into so far, in that we highlight a downside in the profile as well. This story, Sugary Drinks Under Pressure, focuses on companies with exposure to beverage production. Health organizations such as the World Health Organization have raised concerns about the health effects of overconsumption of added sugars. Added sugars, when consumed to excess, have been associated with health problems such as obesity and various types of cancer. The market appears to be responding to these health concerns. We highlight declines in sales and consumptions in key markets. The figure here on the left shows the downward trend in per capita consumption of soft drinks in the US. We also highlight other trends in countries such as Mexico and the United Arab Emirates. Governments are also taking note of the health concerns related to sugary drinks. Some regulators have imposed sugar taxes and other regulations meant to curb the sweet tooth of consumers, as it were. In this analysis, on the right side of the screen, we assess a basket of 5 firms with exposure to drinks, to beverages generally, and we look at key indicators of preparedness to address risks related to some of the key factors that comprise the overall risk profile of the industry. We've profile Coca-Cola as a downside case, the company receives a low score on our metric and is also exposed to controversies related to sugary drinks. Coca-Cola has acknowledged that sugar-related industry risks and recent efforts that these risks pose a potential problem for the industry. The company has also made efforts to gain exposure to other products such as kombucha and coconut water, which are healthier. But the firm is still highly exposed to sugary beverages and the associated risks of the health concerns, the declining demand, the market regulation, and in this case, even litigation. We note that the company is currently facing a lawsuit that alleges Coca-Cola has engaged in a pattern of deception, trying to mislead the public about the health effects of sugar. This raises the question of whether sugar is the new tobacco. Okay, we've now covered 6 of the 10 stories in 10 for 2018. We hope you're gonna take a close look at the report to find more details on these 6 stories as well as the other 4 stories that we mentioned only briefly at the beginning of the report. Now, I'd like to go over some of the updates from our 10 for 2017 report. This is a tradition we do in these reports. We look back at the companies we profiled in the previous year and highlight some of the interesting factors in the company's development. The companies that we focused on and the industries that we focused on pertained to a wide range of interesting ESG themes, from blockchain technology to lithium-ion energy storage. We note that half of the companies that we featured saw a decline in their overall ESG score, which is indicated in the column to the furthest point on the right side of the table on your screen. Only Danone experienced a bump in its ESG score, only a 1-point bump, so it's quite a modest one. The total returns of companies that we profiled over the year ranged from 48% on the high end, which was Panasonic, to -24 on the low end, which was PG and E. The average return of the 10 profiled companies was 13.2%. We expect that the longer term trends in this area, in all the areas of the thematic profiles, will play out in the long run, and we're going to continue to monitor the market to observe how these companies fare and how the overall themes influence patterns in market performance. To wrap up, the figure on your screen shows the 10 industries that we look at in this report, a summary of the risks, the individual companies that we profile, and the outlook we have on each company. This table is in the introduction of the report, so we invite you to take a closer look at this. One point I'd like to emphasize is that the outlook we have for each of these companies that we profile really focuses on their ability to mitigate the risks in question. So we encourage investors and our readers to take the insights that we provide in this report and blend it with your own analysis of these companies to assess the long-term performance of these companies, take into account other factors aside from the ESG risks that we look at, and develop your own evaluation of these companies. We hope that this report will contribute insights to the market and inspire new thinking on some of the key issues that we look at. We think that the stories that we focus on can serve as a base for investors to develop their own assessments of how well industries and companies featured in this report are prepared for the risks that we discuss. Our analysis can also provide examples of what to look for when assessing the exposure of firms of interest that don't make it into this assessment. So the examples that we dig into might provide some insights about what key variables one might look for when analyzing other companies. Finally, we hope that this report will encourage others to develop novel ESG-driven investment theses and further progress sustainable investing in the market over the years ahead. And with that, Loic, I will pass the floor over to you. If there are any questions, we'd be pleased to address them now.
Well, thank you very much, Martin, Ice, and Justin, for presenting these very insightful stories on companies that are facing either water risk or climate change risk or consumer protection issues. We have now about 20 minutes for a Q&A session with the audience. I would like to remind the audience that they can share any question on the report with the interactive box on the right-hand side of the panel. We received a few questions already, and I will start with the following to Martin. The question is actually about the report structure. Why did you focus on risk instead of opportunity for this year's report?
Thank you, Loic. Yeah, we've received that question from a few people. Yeah, it's a different angle that we took this year. Last year, our focus was on upside themes. We were looking at what we thought would be the key ESG opportunities in the market. We think, of course, risk and opportunity are two sides of the same coin. So in focusing on risk, our readers and investors can find opportunities to look for companies that are gaining some competitive advantages by addressing risks in a comprehensive way. But more generally, the reason we focused on risk this year is because we received some feedback from some of our colleagues in advisory services and some of our clients whom we've had discussions with about how one could integrate ESG data into risk assessments. I think investors are increasingly aware of the benefits of incorporating ESG information into analysis of companies and industries and investment strategies. But more and more we hear the term risk coming up. People are interested in how you can mitigate risk using ESG analysis. So we thought 10 for 2018 would be an opportunity for us to demonstrate how we can do that.
And there's actually a follow-up question on this one, Martin. So when you work with our analysts on this report, and you guys were brainstorming on different ideas, did any other risk come up in your research that actually didn't make it into this report?
Yeah, that's an interesting point. The number 10, of course, comes with the series. So we focus on 10 key themes, 10 risks in this case. But of course, we could definitely increase the number indefinitely. There are a lot of other risks that didn't make the cut of this report. Some that we are looking at and could have easily made it into this paper would include risks related to gender diversity. We see in the market, this is a hot topic right now, companies are under a lot of pressure to address some of the issues related to gender equity, with women being underrepresented in the workforce generally, but particularly in higher positions in companies, in the C class, as well as board of directors and senior managers. So gender diversity was a key one. And yeah, others also came up related to cybersecurity, and yeah, quite a few others, but I think maybe I'll leave it at those two for now.
Thanks a lot, Martin. I have a question about the semiconductor industry, and more specifically about TSMC. So this question is, I guess, for Ice. Ice, would you consider TSMC approach, reactive or proactive? Is the company reacting to the energy storage issue, or is it proactively mitigating related risk? What's your view on this?
Thanks, Loic, for the question. So I find TSMC to be in the middle. The reason I say that is, if you look at TSMC among its peers in Asia and also its peers in Taiwan, TSMC is definitely proactive. It invests a lot in energy equipment and energy saving. So definitely proactive when you look at it at a local level. But if you look at it at a global level, in comparison with its European peers and its North American peers, it definitely is reactive, in the sense that it's reacting to the local energy demands rather than thinking about energy mix, renewable energy, and things like that, like a North American or a European semiconductor company would.
Thanks. And actually, I mean, it looks like European companies are actually more prepared to Asian companies to manage energy and greenhouse gases risk. So is that the case, and why do you think that's actually the case?
Yes, that is definitely the case. But when we took a closer look, about 43% of European companies are well prepared to manage greenhouse gas and renewable energy risks, which is comparing that to Asian firms and North American firms, they do far better. There's a couple of different reasons for this, but the major reason is that European companies have access to renewable energy more than their Asian peers. So like they can purchase renewable energy much easily. The infrastructure surrounding that is available, and there's also policies in the European Union that helps these companies to become more prepared.
Thank you very much, Ice. A question came about the real estate industry. So this question will be for Justin. Justin, where do you see real estate companies in the Asia Pacific region progressing to in managing physical climate issues in the next, let's say, 5 to 10 years?
Thank you for the question, Loic. Well, I would say, generally speaking, say in the next 5 years, I would imagine that there's be increased investor awareness on this issue, and subsequently there'd likely be a lot of pressure for companies in the Asia Pacific region to improve their disclosures and strategies on how they address these risks. And let's say 10 years from now, I think it's possible that these companies will begin reporting on these issues at a level that may be similar to their to European counterparts. And I think given enough time, we may even see today where these companies may become the new global standard. Rather, Asia Pacific companies may become the new global standard in this area as their risk exposure increases, and strong disclosure and management will become a necessity as a part of a viable business.
Thanks, Justin. I mean, as you know, Asia is prone to floods and typhoon and droughts. Do companies in operating in this region employ different strategies again, these different physical risks? Do you have any insights here?
Overall, I can't say I've seen companies single out specific strategies to address these individual risks, but for the most part, they would apply an overarching approach that will cover all their operations and all these issues. But at the same time, some disaster-specific mitigations I've seen can include avoiding low-lying, flood-prone sites for development, designing their structures to withstand stronger storms, and the implementation of programs that will help improve water management practices and reduce operational impacts, especially at sites that are very prone to droughts. We're using measures such as water recycling, rainwater collection, and then one other thing I've seen is utilizing landscaping that is not as water intensive.
Thanks, Justin. We have about 8 minutes left, so again, a reminder to the audience that they can submit questions. Follow-up questions about the copper mining industry, and this will be for Martin. The question is about the desalination technology. So that's an interesting, promising technology. But the question that is asked is, did you also look at expenses, cost associated with that technology, Martin?
Thanks for the question. We note that these are expensive technologies, and in doing some of the background research, I saw companies in this area are spending billions of dollars on desalination plants for copper mining projects in Chile and elsewhere. So they are definitely expensive. We didn't incorporate that factor into the assessment. In fact, this is, I think, a good example of how the analysis that we provide throughout this report is one piece of a larger picture. So we focus our analysis on two factors: the proportion of copper produced by companies in Chile and the performance of these companies on our assessment of water risk and community risk factors. So we bring those two pieces of the analysis to the table, and the next step would be to incorporate our findings with other factors, as you mentioned, looking at the costs of desalination would be one of those factors. How does that affect the bottom line of a company like Antofagasta? So that's an open question. It was a little too much for us to address in the short paper that we looked at, but it's a point that is well taken, and I think that's something definitely worth looking into.
Thanks, Martin. Actually, I have a follow-up question about this point. Again, you mentioned that for Chile, water risk and community risk are actually very severe risk in this country. Would it be maybe just safer not to, or let's say, to invest in companies that operate exclusively outside this country, given the extent and the scope of these two major risks?
That could be one approach. You could look for companies with operations in areas that have an abundance of water. in Canada, for example, you can find companies that have major operations, but the premise that we were working on is looking at an area where copper production is such an important part of the global network. And in this case, Chile really stands out. We mentioned 27% of global output is coming from Chile. So you could look for another area where water and community risks are less of a factor, but that would position an investor in a place that would be kind of sheltered from a key market. Chile, we think is really important. So I think that would be something for an analyst and an investor to consider and to weigh the pros and cons. But from my own perspective, I think that key number, 27% of global output coming from Chile, is enough to persuade me that it's at least worth looking into how companies in this area are mitigating the risk, and then combining that information with other factors such as the expenses of desalination and other issues that would affect the prospects of companies working in Chile.
Thank you, Martin. I'd like to get back to ICE because we have a pretty interesting question about the semiconductor industry. ICE, you presented in one of your slides this breakdown between semiconductor production in the world, and clearly Taiwan and South Korea are the largest producer. So hypothetically, if the productivity of Taiwan semiconductor manufacturing industry was deeply, affected, say, by an external shock, how would the global technology industry be impacted by this? What is your view here?
Thanks, Luc. That's definitely an interesting question. The first thing I can think of is like, what will happen to my smartphone? Will the prices go up? That's the thing that concerns me the most. But to answer that question specifically, Taiwan does play a huge role. And hypothetically, if the productivity goes down, there is a possibility for supply shortages, and there is a possibility for price increases because of that. And I believe that a lot of the companies, so like companies like Apple and Qualcomm, they depend on TSMC and other companies in Taiwan to manufacture the chips. So if Taiwan does Taiwan's productivity is reduced, they will place their manufacturing orders in different places. So possibly they'll look at options such as South Korea, which would be a major player would be Samsung, and China, where there's also other players. So there will be definitely redistribution within the supply chain, and but there will be immediately like effects seen in the technology industry because Taiwan's productivity has gone down.
Thanks a lot, Ice. Thanks for your detailed answers. And thank you very much also to Martin and Justin for your contribution. Unfortunately, we've already completed the hour, and we have to wrap up this webinar. I would like to thank you all for joining this webinar, and thanks both Martin, Justin, and Ice for their presentation. We hope that our report provided a useful perspective on the companies and on the themes that we have shared with you, and will generate new investment ideas. So please feel free to reach out to us if you want to discuss some of these stories further with our analysts. And for now, I wish you all a good day. Thank you very much.